90 minutes, that's all it took. A violent reversal hit the gold and silver complex so fast it looked like the market blinked and woke up in a different world. The headline number being repeated is this: about $1.7 trillion in market cap vanished from gold and silver in roughly 90 minutes, one of the sharpest intraday reversals people can remember seeing in precious metals. The claim is circulating widely across market commentary right now, including posts attributed to Kobesi letter and a wave of explainer videos. Source. And here's the grand thesis that matters. This wasn't random volatility. This was systemic revelation. A moment where a hidden mechanism briefly became visible. Because when something that's supposed to be the safe haven can get slammed in a straight line in under 2 hours, you're not watching supply and demand. You're watching structure. And this event is not a one-off. It is the next phase of an unchangeable historical pattern. When debt systems overextend, liquidity becomes more important than truth until the system forces a reset. Here's the credibility anchor most people still aren't emotionally processing. Global debt is sitting near $346 trillion, a fresh record, according to the Institute of International Finance, reported by Reuters. Source, that's the ocean. Gold and silver trade inside that ocean. So when the ocean shifts, metals don't politely adjust. They get ripped. And the terrifying part is not that it happened. The terrifying part is that this is what it looks like when the system is still functioning. So now we're going to do what most videos won't. We're going to explain what really happened. Not with memes, not with they did it again, hand waving, but with a clean chronological mechanism, a 4-stage system, the same one that has shown up for centuries. And once you see it, you can't unsee it, because after this, you'll realize that the $1.7 trillion wipeout wasn't the story, it was the notification. The system just sent you an alert, and most people will hit dismiss. Don't, because the next alert won't be on your phone, it'll be on your portfolio. Stage 1 is setup. This is where the foundation is built, not the foundation you're told about, the real one, the plumbing. In metals, the setup is simple. There's the physical market, and then there's the paper market. The physical market is bars, coins, real ounces, real vaults, real constraints. The paper market is futures, options, swaps, and synthetic exposure. And the paper market is allowed to be huge. So huge that most people don't understand the scale. The BIS tracks the OTC derivatives universe, and the notional outstanding across OTC derivatives is around $846 trillion at end June 2025. That's not metals only. That's the ocean of contracts the modern world swims in. Source now, zoom into metals liquidity. The London bullion market is not small, it's not sleepy, it's a machine. LBMA trade reporting data has shown weekly turnover figures that run into the hundreds of billions. Source meaning, massive nominal value changes hands constantly, mostly as paper claims, netted and renetted. That's stage 1. A structure where paper can dominate price discovery, where liquidity can overwhelm scarcity, where price is often the price of leverage, not the price of metal, and most of the time, it feels stable, because in stage 1, leverage behaves until it doesn't. Stage 2 is expansion, overextension, debasement, the part where the system looks like it's working, while it quietly becomes fragile. Here's the simplest analogy. Imagine a theater with 500 seats. Now imagine someone prints 5,000 tickets. At first, it's fine. Most people don't show up at the same time. The doors don't get tested, and everyone thinks, look how efficiently we sold tickets. That's paper metals, that's leveraged markets, and that's also debt, because debt is the master expansion. Debt is future purchasing power pulled into the present. And when the world is near $346 trillion in total debt, the system must constantly roll, refinance, and reprice risk. Source. This is where metals become dangerous, because metals culturally are seen as insurance. So flows pile in, positioning gets crowded, narratives harden. You start hearing phrases like, this is the new paradigm, it's different now. Central banks are buying. Fiat is finished. Maybe some of that is true. But in stage 2, the market becomes vulnerable to one thing, a forced unwind. Not because people change their mind, but because someone's funding broke. Someone's collateral failed. Someone got a margin call. Stage 3 is crisis, loss of control. This is the moment the system stops trading based on belief and starts trading based on survival. In stage 3, people don't sell what they hate, they sell what they can, and gold is liquid, silver is liquid, futures are liquid. So gold and silver become a source of cash, a place to raise dollars, a place to meet margin, a place to plug a hole somewhere else. This is where you get the impossible candles, the straight line moves, the sudden what just happened, and it often happens in a narrow window because liquidity is not evenly distributed through time. There are moments when order books are thinner, moments when algorithms dominate, moments when one large flow becomes the market. So when you hear $1.7 trillion wiped out in 90 minutes, the deeper meaning is not the number itself. The meaning is the speed, because speed reveals structure. Stage 4 is the outcome, the inevitable outcome. And this is where most people get psychologically trapped because they think the outcome is gold is over or silver is dead. No, that's not the outcome. The outcome is always the same. Stage 4 is the market repricing reality through the least merciful process possible. Forced liquidation, then stabilization, then the next phase. Because the system is not trying to be fair, it's trying to remain solvent. And solvency always beats sentiment. Always. Now, I'm going to prove this pattern is not theory. 3 historical case studies. Tight, clean, less than 300 words each. And each one ends with the same uncomfortable question. First case. 1929 to early 1930s. The setup was leverage, margin debt, speculation, a belief that modern finance had tamed cycles, then expansion. Credit grew, risk piled, everyone got comfortable, then crisis, stocks collapsed, and here's what shocks people. In the earliest phase of liquidation, even safe assets can get sold, not because they're bad, because cash is oxygen. Then outcome. After the dust, the system rebuilt under new rules. The winners were not the people who predicted the crash. The winners were the people who stayed liquid long enough to buy when everyone else was forced to sell. Question, are you positioned like a predictor or like a survivor? Second case, 1971-1980, then the early 1980s reversal. Setup, a monetary system under pressure. Expansion, inflation surged, confidence in currency weakened, and gold became a psychological refuge. Crisis, when inflation expectations and rates collide, volatility explodes. Outcome, gold made a historic run, then suffered brutal drawdowns once policy credibility returned and leverage got punished. The lesson is not gold fails. The lesson is that in a regime shift, gold can behave like a risk asset in the short run and like a monetary asset in the long run. Question, do you know which time frame you're actually trading? Third case, 2008, setup, credit derivatives, and housing leverage. Expansion, the illusion of diversification, ratings games, and cheap funding. Crisis, the funding market froze. Collateral mattered more than story. Outcome, there was a moment where gold dipped during the worst liquidation, then later surged as monetary response escalated. Again, in the panic, the market sells liquidity. After the panic, the market reprices the currency. Question, do you understand the difference between the liquidation phase and the debasement phase? Now we apply the same system to the present moment, step by step, no hype, just structure. Stage 1 today, setup. We've built a global financial system that runs on rollovers, debt at record levels, derivatives at mind-bending scale, and markets where price discovery is often dominated by paper positioning. Check. Verified, undeniable. Global debt near $346 trillion is not a vibe. It's documented. Source in the derivatives ocean around $846 trillion notional outstanding isn't conspiracy. It's BIS. Source stage 2 today, expansion over extension. This is where people misread the metal move. They assume rising prices are purely fundamental. But in late stage cycles, rising prices are also a signal of increasing fragility because higher prices attract more leverage. More leverage increases liquidation risk. And when liquidity is deep, that leverage can build quietly. Meanwhile, the macro backdrop keeps pushing the same direction, debt, deficits, and warnings from the people sitting closest to the plumbing. Jamie Dimon has repeatedly warned about the trajectory of U.S. debt, calling it a predictable problem that will bite and potentially cause bond market turmoil. Reuters covered diamonds warning about rising U.S. debt and potential bond turmoil. Source. When the guy running one of the most systemically important banks says the debt path is a big deal, that's not a Twitter thread. That's a smoke alarm. Check, verified, undeniable. Stage 3 today, crisis, loss of control. This is the phase the $1.7 trillion wipeout belongs to. And here's the key point. Most people are asking the wrong question. They ask, who dumped it? The right question is, what kind of market can be moved like that? Because in a true physical market, you can't erase trillions in 90 minutes. Not without trucks. Not without vault movements. Not without settlement bottlenecks. But in a leveraged paper market, you can. All you need is a crowded positioning, a trigger, a liquidity window, and a cascade. The $1.7 trillion figure is being circulated in market commentary and social posts describing one of the largest reversals in history. Source. So what are plausible triggers? Not one magic reason. A convergence. Profit-taking after extreme moves. Margin calls elsewhere forcing sales. Rate expectations shifting. Dollar liquidity tightening for a few hours. Options gamma effects pulling price toward a magnet level. Stop-loss clusters. Algorithmic momentum. And the important part, these triggers don't need to be big. They just need to hit when the structure is fragile. Because in stage 3, the system is already leaning. You don't need a hammer. A finger tap works. And then it looks like the market crashed. But what actually crashed was leverage. Check, verified, undeniable. Stage 4 today, outcome. This is where we separate amateurs from operators. The amateur says, so gold and silver are manipulated, I knew it. The operator says, so liquidity is king, and the system just revealed how it will behave under stress. Because the real outcome of a flash wipeout isn't just lower prices, it's changed behavior. Dealers widen spreads, exchanges adjust margin, funds reduce exposure, retail panics, narratives flip from greed to fear, and then, quietly, the next setup begins. And here's the part you need to hear in slow motion. If we are in a long-term regime of debt overhang and chronic refinancing pressure, then both things can be true at the same time. Gold and silver can be the long-run hedge against debasement, and gold and silver can be a short-run source of liquidity during liquidation. That is not a contradiction. That is the pattern. Now, I'm going to say something that will make some people angry. If your entire thesis is gold only goes up when the system breaks, you do not actually understand breaks. Breaks happen in phases. First, the market sells liquidity. Then, policymakers respond. Then, currency confidence erodes. Then, the monetary hedges reprice. If you confuse phase 1 with the entire movie, you will panic at the exact wrong time, and you will miss the point of owning insurance. This is why most people get destroyed in exactly the moment they were right. They're right on direction, wrong on sequence. Now listen carefully because this is where retention matters. I'm going to give you a mid-video call to action, and it's not the usual one. If you want the next segment, where we break down the exact mechanics of how a 90-minute cascade forms, including the leverage chain, the paper-to-physical disconnect, and what signals to watch before the next wipeout, then subscribe right now. Because the next video won't be theory, it'll be a survival manual, and you're going to want it before the next alert hits. Now let's finish this with misconceptions and practical takeaways. Misconception number 1, this time is different. No. Different technology, same balance sheet math, same human behavior, same leverage cycle. The IIF debt record near $346 trillion is the opposite of different. It's the same pattern at larger scale. Source misconception number 2, technology will save us. Technology increases speed. It doesn't remove risk. If anything, it compresses time. It takes what used to happen over weeks and forces it into 90 minutes. Misconception number 3, American exceptionalism means the rules don't apply. Debt is not patriotic. Funding markets are not emotional. When the head of JP Morgan is publicly warning about debt and bond market turbulence, you are watching a system insider point at the same pattern we just mapped. Source now practical takeaways. First, separate long-term thesis from short-term vulnerability. If you hold metals as long-term insurance, you must mentally and financially prepare for short-run drawdowns that look irrational. Insurance is not supposed to feel good while you buy it. Second, position sizing beats predictions. If a 90-minute move can erase what feels like years of progress, then your size was too big. Not because you were wrong, because you were fragile. Third, understand the liquidity hierarchy. In panics, the market sells what is liquid. That can include gold and silver. So if you need emergency funds, don't rely on selling your hedge during a cascade. Keep separate liquidity, cash equivalents, short duration instruments, dry powder. Fourth, watch the signals that precede cascades, crowded positioning, volatility compression, sudden spikes in intraday volume, sharp moves around key macro releases, and widening spreads in related markets. You're watching for the system to lean, because once it leans, the smallest trigger can shove it. Fifth, stop treating the $1.7 trillion number like the main story. The main story is that the structure allowed it. If you can't explain the structure, you can't manage the risk. And finally, here's the concluding inevitability statement. The pattern is absolute. Stage 1 builds leverage. Stage 2 expands it until it becomes fragile. Stage 3 forces liquidation. Stage 4 resets the board. That cycle is not political. It's not optional. It is the physics of leverage systems. So the question is not, will it happen again? The question is, what will you do when it does? If you want the next segment, where we turn this into a step-by-step playbook, and I show you how to position across the liquidation phase versus the debasement phase, subscribe and watch the next video the moment it drops. Because if the market can wipe out $1.7 trillion in 90 minutes, it can wipe out your confidence in 90 seconds. And confidence is the first thing you lose, right before money.